This week on Commercial Real Estate Secrets, you are going to learn what cost segregation is, what depreciation is, and how you can save hundreds of thousands, if not millions of dollars doing so. This week's listener of the week is CC14. CC, thank you so much for leaving us a 5-star review. And for those of you listening, if you leave us a 5-star review below, you might be next week's listener of the week. This week on Commercial Real Estate Secrets, we have Mr. Joe Viery. Joe is the founder of U.S. Tax Advisor Group, Inc. Joe, thank you so much for being on the show today.
Thank you, Aviva, for asking me.
Joe, let's talk. Who are you? What do you do? And how did we get here today?
Well, I have a very unique story. I've always been an entrepreneur. I'm going to make it quick. I was in the travel business doing incentive travel. If anybody knows what that is, trips for people who sell so many widgets, they get to go to Hawaii or Hong Kong. And then in 2000, I sold the business and I got involved with the California Association of Realtors. And I was involved in helping the realtor themselves and their clients with tax planning strategies pertaining to real estate. Then we all know what happened in 2007-8. Right before that, I had a friend of mine who kept wanting me to share with me this strategy. And I kept blowing him off because I thought, oh, he probably wants to sell me soap from Amway or something. And finally, I said, okay, Mike, let's go have lunch. He explained to me about this concept called cost segregation. I asked him what it was. He told me I had clients that were staring down a $50,000 income tax bill by the IRS. I saved them the $50,000. The car went over the cliff as far as the depression went, and the California Association of Realtors job evaporated. So the company that I did these two projects with, came to me and they said, hey, why don't you come work in cost segregation? You're really good at it. You know the fundamentals. And I did not take 2 seconds. I jumped right into the industry. And then in 2017, I started my own firm, which is U.S. Tax Advisors Group Incorporated.
Joe, if I were a fifth grader, how would you explain cost segregation?
I think I can do it really, really well. Basically, everybody should understand that you have to pay income taxes. You pay income taxes on your income. If you have no deductions, or even if you have deductions, if you have no deductions, it's going to be called your gross taxable income. So let's make the math simple. Let's just say, for example, your gross taxable income is $100,000. And bottom line is your accountant says you're in the 40% tax bracket. You're going to pay 40% of the 100,000. You're going to pay $40,000. No questions. That is what you owe. However, if you can reduce your $100,000, guess what? You're going to pay less income taxes. So what we do in the depreciation world is your depreciation in real estate is an expense against income. So now let's take that same exact scenario. You have $100,000 in gross income. I give you a $50,000 expense, which is depreciation, accelerated depreciation. So now your gross taxable income is not 100, it's 50. I, in essence, wiped out 50% of your income taxes due. And if you don't need all of the benefit I give you, it carries forward until you use that bucket all up.
So you must make a lot of friends in this business.
I do. I make a lot of people very, very happy because I have so many. I'll give you one real quick story. It's a guy that owned a hotel, and bottom line is he did not need me. 8 months later, he calls me. He says, Joe, I need you. What happened? I got refinanced, and now my accountant is telling me I owe $120,000 in income taxes. This was during the Depression. This was like 2009-10. Hotels were getting killed. He goes, I can't pay it. I have no income. I can't pay the $120,000. I did cost segregation. I wiped out his $120,000.
Bingo! You made a friend.
Made a friend, and then he introduced me into one of the biggest developers of real estate in the United States. Hotels, senior centers, apartments, and wow. I do all of their work. So it worked out to be a very good deal for both myself and for him.
Isn't it funny how leads take you places you never could have imagined?
My mantra is you never know what's behind the next door. So you can never take it. Oh, this little guy owned a little hotel, no big deal. I didn't know his best friend owned a company that owned billions of dollars of real estate.
Hey, never judge a book by its cover, never judge a lead. I have to remind myself that all the time.
Words of wisdom.
So how do you go about cost segregation and depreciating a property?
Now this is where the weeds get a little thicker, but I'm not a weed man anyway, so I'm just going to keep it very simple. Bottom line is all we're doing, and it's very simplistic to explain. The IRS says we recognize you are using up. I'll use a kindergartner's term. You're using up your building as we speak via time. Time erodes everything. I don't care if your building is 100 years old, it's disintegrating as you're using it, owning it, or living in it. So bottom line is what the IRS says is you can now take that expense every year. Well, you want expenses. I just explained why. So what they said, the easy way of doing it, and I can get a kindergartner in here with a calculator or maybe their cell phone or iPad, and all you do is you take the purchase price of your building when you bought it. Part of that price is land. Land is not depreciable. So somebody's got to take the land off. So let's just use again simple math. You buy a $1.2 million building. Somebody says 200,000 is the land. Now I have $1 million building basis. That is what you depreciate. If you do it the easy way, you take that $1 million, and if it's residential building, you divide by 27 and a half. If it's a commercial building, you divide by 39 years and you get straight line depreciation for the next 27 and a half or 39 years. However, there is another part of the code where the IRS agrees that there are many, many hundreds and hundreds of components in the building with shorter lives. So for example, everything on the outside of the building is a land improvement. Those that I can accelerate on the inside of the building is personal property, 5-year property. So our job is to peel off all of the short-lived assets, 5-year, 7-year, 15-year property. You're always going to have the main building as 27 and a half or 39 years. What is that? I mean, the roof, the foundation, I can't touch that. What I'm looking for are the land improvements, and I'm looking for in the interior building items like flooring, window coverings, countertops, cabinets, molding, crown molding. I mean, it goes on, and mirrors, it goes on and on and on. And what we do as engineers is we dissect the building and put everything in the short life assets, as well as, again, remaining in the long-term asset. That's in nuts and bolts. That's all we do. At the end of the day, after 27 and a half years, guess what? You're going to have the same amount of depreciation. All we're doing is we're enabling you to get that depreciation up front in the year that you bought it, instead of waiting and getting a little bitty deduction over 27 and a half years. Bada bing, we're going to give it to you in the first couple of years you own the property, and it's the time value money. You want those expenses when you first own the property. You don't want your expenses 27 and a half years down the road. That's bad planning. That's why cost seg is so powerful.
So let me ask you, this is a little bit left field, but what is to stop a bad actor, say who has buddies who own real estate, to go into cost segregation and then lie about what the building actually has inside of it or that it's built of to depreciate? How do we mitigate that?
There's only one way, and to do that is make sure who you're hiring has got the background, and they know what they're doing. Our Bible, my Bible, what we go by at U.S. Tax Advisors Group, the IRS published a document in 2004 called the Audit Technique Guidelines for Cost Seg. Well, guess what? That's the Bible that tells their agents what to look for in a quality cost seg study. That's what we do. We use everything quality study. We use the IRS's own recipe. So for example, if we're doing a detailed engineering, meaning that the building basis is over $1 million, we have to go to the property and measure it and document it. If we do a smaller building, which by the way, we're very unique, we're one of the very few that do smaller buildings. We can do single family homes, and how we can do it and make the math work, meaning the fee low, is that we can do it without the engineer leaving the office. We can do it analytically, and we are great at doing it. It is not the number one type of study. The number one type of study is you go out there and measure, but it's still approved by the IRS. It's still compliant, and it's still a great study, and it's better to have some depreciation than ignoring it and not getting any accelerated depreciation. So we're unique when we do the smaller single family homes, smaller commercial buildings, doctor's offices, anything with the building basis under $1 million.
So, say I'm an owner and I want to sell my property next year. Should I run a cost segregation study, or what's my best line of defense there?
Okay, there's a couple of reasons, very few, why you should not do cost seg. And we tell this to everybody, and it's their decision, but we will tell them, I don't think you should do cost seg. Don't do it. One of those is depreciation recapture, is what happens when you sell the building and you have to pay back your depreciation. Therefore, the way the math works in our minds is if you know you're going to sell the building next year, don't do cost seg. If you know you're going to sell the building in 2 years, don't do cost seg. We want people who are planning to own the building at least 2 years or longer, and that is when the math is the most powerful, all because of depreciation recapture. However, I'm going to give all of your listeners a little Joeism on this. I'm not an accountant or I'm not an attorney, but I will tell you something surprising. Those who have long-term hold in real estate, meaning 2 years or longer, cost segregation reduces depreciation recapture.
Hmm.
It's a high level. It's a high level process. All of my accountants who really know cost seg use this, so they would have to call me, and I could tell them how it reduces depreciation recapture. But most accountants don't know this.
Wow.
And so keep that in the back pocket, knowing that if somebody tells you don't do cost segregation for depreciation recapture, it is true if you're not going to hold the building for at least 2 years. I will agree. But if you are, no, you want to still move forward and do cost seg.
Super interesting. So let me ask you, if you do cost segregation on your property, are you more likely to get flagged by the IRS?
Boy, this is a great topic because in my first years when I did this, what was going on is most people didn't even know how to spell cost segregation. They never heard of it. That goes for accountants too. So what I had to do is I had to allay their fears and go, no, this is legal. Here's the IRS code. Look it up yourself. It's legal. It's legal. Everybody thought it was a scam, and
Wow.
it didn't work. But nowadays, the IRS published the audit technique guidelines telling the agents and their customers, me and you, who pay taxes, they tell us, yes, cost seg is real. So you are not going to get audited for cost seg. Now, maybe you could get audited for another reason. We stand by our work. We defend our work. If there's ever any questions by the IRS, I've only, believe it or not, been audited. Well, it wasn't even my fault. It was the client's fault. They did some funny business, and I got audited twice, but I've never lost it. The two that I was involved in, I didn't lose. So it's possible, of course. The
Sure.
IRS is hiring a lot of agents out there, but if they do have questions, we will not charge you. We will defend our work. So that's another thing. When you're looking for companies, make sure they will defend their work.
That's interesting. So, what do you think? I mean, this might be a little woo, but I love talking about the future. What do you think the future of tax segregation holds?
Well, there's a couple things going on, but number one, just my opinion again, because we're talking politics, and we've got both sides of the fence, and we've got the IRS, and we've got courts, and blah 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 blah. Bottom line is, depreciation has been in the tax code since about the 1920s, I believe,
Hmm.
meaning that it is so baked into the code that if Congress ever tried to get rid of it, holy smoke, I, I cannot see it. Do I know the crystal ball? I have no idea, but I would say cost segregation will be here another 100 years. I would not worry about that at all. I would not worry about being audited. I would just worry about getting a quality company to do
Hmm.
the work that knows all the rules and regulations. That's what I'd be concerned with.
Uh, it's an interesting day to have this conversation. Today is November 5th, 2024. The presidential election concludes today, and I'm not saying right, left, up, or down, but I like to put a little timestamp on things, and it's an interesting topic on an interesting day. They talk about the same thing with the 1031 going away, and it's like, uh, what would happen to our industry if that happened? I don't want to think about it, but hopefully we never have to have these discussions. So
Yeah, and that's another one too. 1031 exchanges. Again, my world, my prison. I don't think that there's any way Congress could even begin to try and take that away. I think that the taxpayers would cry bloody murder and make their lives so miserable that they wouldn't get it passed.
sure. Hey, good.
Who knows?
Yeah. Let me ask you one more question. I have some notes here. So, say I'm a landlord and I have incurred some epic losses because of the pandemic or because of a weather event. How can cost segregation help me recoup my losses?
You know what? Here's the situation. I am going to kick the can on this one because I'm not an accountant. And now that is
Sure.
probably going into the weeds of accounting. I can sometimes give my opinion. All I can tell you is that I do have many clients and their accountants who are using cost seg to mitigate that issue, their losses. They're using it to mitigate capital gains taxes because it's not like if you don't pay income tax and I give you a bucket of losses, you can use those losses when you sell the building against your capital gain, even if you don't need them against your income. Because don't forget, real estate has a lot of preferential tax treatment. So you may not have a tax loss this year, but I guarantee you if you sell the building for profit, you're going to need cost segregation to reduce the capital gains. So
Sure.
it's very rare that there's a reason why somebody wouldn't do it, but definitely I would have their account. And one of the great things with us, U.S. tax advisors, is we give you a no cost estimate. So what I always suggest, get the estimate, get the fee, take it to your accountant and say, look, Joe is going to give me X in losses. What can I do with these? And let him tell you what you can do with them. It could be nothing, and I will support the accountant. Or it
Yeah.
could be, yeah, you want to move forward, which is most of the time with our clients. They always want to move forward.
Amazing. I think uh, we've got a lot of property owners who listen to this show. I'm excited for them to get your information at the end. But before, we always ask on Commercial Real Estate Secrets, what makes you happy with what you do day to day in commercial real estate?
You just fed the shark. So bottom line is, well, you know what it is. It's like one of the reasons I was attracted to this industry is what am I giving my clients? I'm giving them incredible cash flow. So in other words, if you were to pay $50,000 in income taxes, let's say 100,000, because some of my people save the small buildings, you save, anywhere from 15, 20, 25,000. But my big buildings are saving millions and millions of dollars. And so so what's my payoff? I love it when I can tell a client, I just saved you $100,000. You know what you can do? You can go out and either improve your properties or maybe you can buy more property and stay in the game and use that cash flow to buy another, single family home, another duplex. And so that's what gives me joy. I love that I don't sell, no offense to washing machine salesmen, but I'm glad I don't sell washing machines or copiers because what I give people is money and it really makes them happy. And I love that.
Hey, I can relate.
Yeah.
Joe, for the listeners who may be interested in cost seg and your services, learning more, etc., where can they find you, follow you, contact you, etc.?
Okay, perfect. The company is U.S. Tax Advisors Group Incorporated, which is very simple. A lot of our clients call us as Ustagi, which is USTAGI. So if they go to USTAGI.com/CRE secrets with an S, plural, /, they'll be taken to the website and we will ask them for their information and we will run the estimate for them. So again, it's Ustagi, USTAGI.com /CRESECRETS /, and there you go.
And we will put that in the show notes. Joe, thank you so much for being on the show today.
Oh, thank you. I appreciate you.
And for everybody listening, we'll see you next week. Thank you for tuning in to Commercial Real Estate Secrets. If you have found our podcast to be valuable, please be sure to subscribe, rate, and review on your favorite streaming platforms, and make sure to follow us on social media at Aviva Real Estate. For brokerage services or to get in touch with us, head over to thewarehousehotline.com and submit a contact form. My name is Aviva. This is Commercial Real Estate Secrets. We'll see you next week.